Hi, you guys. Welcome back to the channel. My name is Brad. This is the Firefighters Financial Toolbox. Today, we're going to be talking about the 8 biggest investing mistakes that investors make. We're looking at an article by Christy Bieber. This is on the Motley Fool webpage, you guys. And if you haven't checked it out, there's a lot of good information there. So take a look. Investing is key to building wealth, but you could undermine your efforts if you make some common errors. Recent research from the Natixis Global Survey of Financial Professionals identified the 8 biggest investment mistakes financial professionals believe are the costliest errors you can make. Here's what they are. Number 1, panic selling. A whopping 93% of financial professionals identified panic selling as a top investing mistake, with good reason. When you see your account balances start to fall or look shaky, it's hard not to make the decision based because fear of losing everything is real. Unfortunately, selling when the going gets rough is a surefire recipe for disaster. It means you'll always end up selling low and missing out on a recovery that inevitably follows any market correction. The good news is that this error is easy to avoid if you have a solid investment strategy. If you're confident in your investments, you can step away from your portfolio during downturns and avoid the temptation to sell. You guys, this is really important. People say, oh, I won't sell. But when you watch your balance going down and down and down, it is really hard to resist. 2, trying to time the market. Okay, we've talked about this a lot. Nobody can time the market. Even the professionals screw it up. So if they can't do it, don't think you can. On the surface, aiming to buy stocks when share prices hit rock bottom and sell when they're at all-time highs seems like a good strategy. The problem is most people can't predict exactly when the share prices will hit that point. And even just a few good days missed in the market due to poor timing could leave you hundreds of $1,000s poorer. You guys, a lot of times when markets hit bottom, some of the biggest days coming back are right in the beginning. And if people get out and they don't get right back in, they miss those big days and they can miss out on a lot of money. That's why it's not surprising that 50% of financial professionals list market timing as a top mistake. This too is easy to avoid though. Dollar cost averaging or buying shares on a regular schedule over time eliminates the need to determine the perfect moment to buy shares. So you guys, if you're contributing regularly to a 401k or a workplace plan, or if you put a certain amount into your Roth IRA every month, you're dollar cost averaging. You're helping solve this problem. All right, number 3, failing to understand your risk tolerance. There's generally an inverse relationship between risk and potential reward. Obviously, the riskier the investment, the greater the potential returns. Unfortunately, 45% of financial professionals indicate that a failure to understand risk tolerance is a top mistake investors make. You need to make a calculated, informed choice about how much risk you're willing to take in order to decide how much you should put in stocks, as well as whether to invest in index funds or individual stocks which provide a chance to beat the market. Risk tolerance is something that should change over time. Before you start seriously investing, though, think about how comfortable you are with taking chances with your money. Here's the thing, you guys. A lot of people say, oh, I have all kinds, my tolerance is high, I'm fine. And they're the same ones that the first time the market starts going down, they sell. If that's you, err on the side of being a little more conservative. Number 4, having unrealistic expectations of returns. This is a good one, you guys. It's important to make reasonable projections about how much your investment will earn. If you expect a 20% annual average, you may think you need to invest a lot more than if you expected a 2% average. Unfortunately, 43% of financial professionals indicate that unrealistic expectations of returns is a major mistake investors make. You guys, even the long term, the stock market is 8 to 10%. Now, that doesn't mean you won't have a year where you get 20%, but it's not realistic long term, and you have to understand that getting into it. All right, number 5, taking too much risk in pursuit of yield. This kind of plays on the last one, right, you guys? You put all of it in stocks because you want to chase those big yields. While many investors misunderstand their own risk tolerance, others take too much risk and gamble with their futures. That's why 25% of financial professionals identify taking too much risk as a costly investment mistake. If you invest in high-risk investments or put too much of your money into the market, you stand the chance of facing outsized losses. In other words, you guys, you could lose everything. Now, that's never happened, but the potential is there. If you're saving for retirement, for example, subtract your age from 110 to determine what percentage of your portfolio should be in the stock market. Number 6, failing to recognize the euphoria of an up market. Okay, this is kind of the opposite of market timing, right? When markets are doing well, everybody wants to get in. Everybody's talking about how well Bitcoin's doing. Everyone's talking about how well the stock market's doing. And everybody wants to buy in. The problem is they're buying at highs. This is the opposite of panic selling, and it can be a very costly error. When investors get too excited that things seem to be on the upswing, this leads to asset values escalating without justification. You could easily end up buying up in a bubble and get stuck with a portfolio full of overvalued stocks. Once again, the good news is dollar cost averaging will help you in this situation. Number 7, focusing on cost rather than value. Far too many investors focus too much on share price at the expense of considering what shares are actually worth. This often still leads to an inaccurate belief that stocks are under $5 are a bargain, even if the companies are unproven or haven't published much financial information. It could also lead inexperienced investors to assume that stocks with high share prices are worth their cost because of their high price tag. These types of errors are likely why 19% of professionals identify a focus on cost rather than value as an expensive mistake. The reality is a stock that costs $5,000 per share is a better value than one that costs $10 per share if the first is likely to double and the second is most likely to lose half its value. You guys, what they're saying is just because a price is low, it doesn't matter. Each company has a different stock price for a certain reason. And you have to look at other indicators, the value, the price to earnings ratio, a lot of different things, especially if you're considering investing in single stocks. And finally, number 8, failure to consider tax implications of your investment choices. 9% of financial professionals indicate that a failure to consider the tax implication of their investment is a costly error people are making. This can be a problem if, for example, investors miss out on a chance to take advantage of favorable long-term capital gains rates, or if they don't engage in strategic tax-saving moves, such as tax loss harvesting, or understanding the tax rules that apply to the investment income is a good way to take this error. Now, they're talking about taxable accounts, you guys, but a lot of people are running out and starting these taxable brokerage accounts without maxing out their 401k or their Roth IRA, and they're missing the tax benefits of having these monies in tax sheltered accounts. What do you guys think? How many of these 8 common mistakes have you made in your investing career? I've been guilty of some of them for sure. And I'm honest enough with myself to admit it. The best thing is that you learn from your mistakes and you try very hard not to repeat these mistakes in the future by doing certain things. We talked about dollar cost averaging. Always putting money regularly into these accounts will mitigate some of this. The other thing is, you guys, if the markets are falling or going up really fast, don't look at the headlines. Ignore CNBC. Ignore the noise. Just keep investing. We can't control where the market goes. All we can do is control the amount of money we save and try to make as few mistakes in investing as we can so that we'll end up with a good outcome in retirement. All right, you guys, I hope you guys enjoyed this. If you did, do me a favor. Give me a thumbs up. It really helps the algorithm. If you're new to the channel, you're not already subscribed, you know the deal. Hit the red button, ring the bell. All right, we'll see you. Thanks.